Good afternoon. I want to thank everybody for logging in and calling in today for the webinar we have here at Advanta with talking about prohibited transactions today. We've got a special guest who's going to join us here in just a few minutes and talk about prohibited transactions, kind of a neat topic we haven't done before, so we look forward to sharing some good information with those who are logged in live to the call and those who are watching the recording. As we go through the presentation today, anyone who's listening to the class live, there's a chat box on your screen that you can type your question into. As we go along, we'll do our best to get to as many of the questions as possible within our allotted time. If you're someone who's watching the recorded version, just jot down your questions as you watch the webinar, and then my contact information and our guest contact information are both in the webinar today. You can reach out to one of us after the presentation. My name is Scott Maurer. I'm the Director of Business Development for Advanta IRA. I've been with the company now since early 2006. At the time I started, we're doing a lot of transactional work and helping people buy and sell the assets in their account. Spent more time the last few years of doing the education and marketing, now some of the business development for our company. I'm also a licensed attorney like our guest today, although I do not give any legal work or give any legal opinions to our clients. Now, a lot of what we talk about today in discussing prohibited investments, potential prohibited transactions, gets into a lot of legal area. And although we can wade into that area and make you aware of some issues, you would need to, before making a determination of an investment and have it that has legal connotations to it, get the advice of an attorney. If it's a tax issue for you, get the advice of a CPA, which again our guest is both today, so you'd have kind of a good source here to reach out to get those questions answered. But again, in Advanta IRA, we don't give any legal or tax advice. We certainly don't give any investment advice as well. So if you're looking at making an investment, we will not say yay or nay from a good or bad idea perspective in making that investment. So rely on those other parties, and if you need some additional resources, you can certainly always ask us to get you those. For those who are new to Advanta IRA, with a little bit of background on our company, we've been around since 2004. The only thing we do at Advanta is administer self-directed IRAs. We don't handle any non-qualified money, so the only funds, the only assets under our administration are those that are held within a retirement account, whether that be an IRA, Roth IRA, maybe an old 401k plan. We do have a very dedicated staff. We really have a lot of attention to customer service, and by providing an account manager system where each new client gets assigned to a particular individual, hopefully our clients are finding that system works well and providing them with better service as opposed to some of our competitors. Now, just very briefly, why haven't a lot of people heard about self-directed IRAs? I think the simple reason and the simple answer to that question is most people simply are not familiar with them because they don't get offered the ability to self-directed IRA by the companies that are holding their retirement account. So whether it's an IRA held with a bank, an IRA held with a brokerage firm, those companies offer the products that they sell. They don't allow you to invest into real estate, private mortgages, and some of the other assets because it's just simply not within their business model to offer that. IRS regulations do allow for a very broad range of investments, whether it be actual physical real estate, whether it be some type of paper asset like a mortgage loan, unsecured notes, option contracts, etc. And then kind of just another category, a catch-all, including LLCs, private partnerships, etc. A lot of different things that you can do within the IRS code. And the purpose really of today's webinar, though, is to discuss kind of what you can't do. Because when the IRS was creating the rules for IRAs and what would the allowable investments would be, they simply decided to list some of the prohibitions on things that you can't do within the IRA, and that's Mr. Buckley, who's going to join us in just a minute, will share some of that with us today and hopefully get some of your questions answered. Again, if you have any questions and you're listening to this live, make sure you type your question in the chat box, and we'll again do our best to get that answered. Now, when the IRS wrote the code in Section 408, they listed the prohibited investments that an IRA or retirement account cannot make. And those investments are only two investments listed are either life insurance or collectibles. And the collectibles would include your antiques, alcohol, artwork, collectible stamps and coins. These are the prohibited investments that an IRA cannot hold. The other area that the IRS has placed restrictions on your ability when investing with your IRA account is listing certain disqualified persons, individuals that your IRA is prohibited from transacting with. And for your IRA account as its own entity, those disqualified persons include yourself as the IRA owner, your spouse, your parents and grandparents, your kids and grandkids, and also any business or entities that are owned or controlled. And certainly our guest today is going to expound on some of this as well in defining not only who some of these disqualified persons are, but also what a transaction between the two might involve. So without further ado, I'm going to bring on our guest speaker. It's attorney and CPA Alan Buckley. He practices in the area of employee benefits, tax law, estate planning, and business, doing some administrative law as well. And you can see on this slide his educational credentials, obviously a BA, a JD, and an LLM in tax at the University of Florida. And as I mentioned, not only does Alan practice law primarily, he also is a licensed Georgia CPA. So he's got a very good understanding of a lot of different things when it comes to IRAs, not only from the tax side, but then also from what's prohibited and what's not allowed. And you can see his contact information here on this slide. But Alan, are you there?
Yeah, I'm here, Scott.
All right, great. Well, I'm going to go ahead and we can get the seminar started. Is there anything else you wanted to add to your bio just to let people know a little bit more about you?
No, I think you've covered it well enough.
Okay. Well, without further ado, I'll kind of jump in the slides, and I'll let you take over, Alan. If anyone has any questions, please type them into the chat box.
Okay. All right. The legislative history behind the prohibited transactions suggests that the reason behind the rules is to encourage the use of IRAs to accumulate retirement savings, and not to have those who are in control of their IRAs take advantage of the tax benefit from their personal account. So these rules are kind of hairy, and there's not a lot of authority outside of the code and a few regulations and a few cases that really provide guidance. And I call this area of tax law the Wild, Wild West, because in most areas of taxes and also employee benefits, there's just a lot of authority and everything is sort of hammered out. But in this area, it's the Wild, Wild West, and I hope you'll get a feel as we go along of why that's the case. The second bullet on this slide says the investor is required to treat an investment by the IRA as an arm's-length investment transaction. And if you sort of keep that in mind, you're probably going to stay out of trouble. That's the main thing you have to keep in mind, is treat it like it's any other investment that you'd have. For example, if you have a self-directed IRA and you were going to buy some Coca-Cola stock, well, what would you do? You'd buy the stock, you might monitor it to see how it's doing, and you'll sell it. But you wouldn't go down to the Coca-Cola headquarters and expect to be able to, sleep in the lobby, and you wouldn't be able to go to the local warehouse and grab out a 12-pack whenever you want it. So it's kind of the same thought process. You can apply that here with your with investments bought by your IRA, be it real estate or something else. It's the same general concept. Don't use it and don't treat it as anything other than an investment, and you should be okay. So that's the general thought. So next slide. These rules were actually created, if you read the legislative history of ERISA, which is the Employee Retirement Income Security Act of 1974. The rules were, if you read the legislative history, it's pretty clear that all these rules were designed for retirement plans. And then sort of at the last minute, they created IRAs and said, oh, yeah, well, these rules apply to IRAs as well. So some of the rules don't really fit well for IRAs because they weren't created for IRAs. So, for example, there's a 15% excise tax on the amount involved in a prohibited transaction. And a prohibited transaction is just, as it sounds, it's a transaction you can't do with an IRA or a tax-qualified plan. A tax-qualified plan is a pension plan, a 401k plan, a profit-sharing plan. So the general rules are written for qualified plans. If there's a prohibited transaction, the disqualified person who participates in the prohibited transaction. And a disqualified person is that list of people Scott just mentioned, plus or minus a few others. The disqualified person has to pay a tax, and it's generally 15%. If it's not corrected within a certain amount of time, it goes to 100% of the amount involved. And so it's a pretty big no-no, and there's a tremendous incentive to reverse a prohibited transaction once it's occurred. Now, again, for IRAs, sort of an afterthought, they said, hey, well, let's just say if an IRA has a prohibited transaction and the owner is the one who commits it, the IRA no longer exists. So that's going to be the remedy. And that is the statutory remedy, that if the IRA owner, that is the person who establishes the IRA, commits the prohibited transaction, and the assets of the IRA are deemed distributed on the first day of the year in which the prohibited transaction occurs. Thus, assuming it's a traditional IRA, it's all ordinary income that comes out. And if the owner is under 59 and a half and not disabled, then there's a 10% penalty. And there can potentially be other penalties down the road, depending on when it's picked up. So we had a transaction many years ago where a prominent partner with a large law firm here in Atlanta had committed a prohibited transaction with his self-directed IRA, and he was fuming and threatened to sue the custodian, which back then was this was a large bank, and so we represented the large bank. But he didn't want it to become public because it would be kind of embarrassing because he was a partner with a large law firm, so we eventually settled the matter. But keep this in mind, a couple things. If you've got Roth money and you've got a prohibited transaction, what happens? Well, the way a Roth works is if you have a distribution, it's not like a lot of distributions from annuity. Like a distribution from an annuity typically comes pro rata from basis and income. So if you put $100,000 into an annuity and you can take everything out of the annuity and get $150,000. Well, what that means is you'd have $50,000 of it will be income and $100,000 will be return of basis. Okay. Well, if instead of getting $150 out of the annuity, let's say you only got out 50 of the $150. Well, still, 2/3 of what you took out would be a recovery of basis, and 1/3 would be income. So, but with that in mind, Roths don't work that way. The way a Roth works is you recover, the distribution comes first from your basis in the Roth IRA. Well, how do you get basis? Either from Roth contributions to an IRA, to a Roth IRA, or from conversions. If you did a Roth conversion, you're going to pick up income to the extent of the conversion amount. Well, let's say you had contributions to a Roth IRA of $20,000, and you had another Roth conversion of another $40,000, so you'd have basis of $60,000, the $20,000 plus the $40,000. If somehow, the total value of what was in the IRA was $70,000, and you had a prohibited transaction, you'd only have income of $10,000, $70,000 minus the $60,000. And if somehow you took money out of the Roth IRA, you could go up to $60,000 completely tax-free, even if you're under age 59 and a half, because you only have income to the extent you exceed your basis, and you don't have the 10% penalty until you have income. So what you can do here is if you got a transaction that you want to do that's kind of risky, and you've got a big IRA, well, create a smaller IRA. You can do a direct rollover from an existing IRA, whether it's traditional or Roth, and just move some money to another IRA. You can have 1 million IRAs if you want to. There's no limit on the number of IRAs an individual can have. And if an IRA is disqualified because it because a prohibited transaction has been committed, only that IRA is disqualified. It does not impact the remainder of the IRAs that the owner owns. So, two things you can do here to protect yourself if you're going to do a risky transaction. A, set up a separate IRA. And B, if you've got a Roth IRA, that's even a better source because it's if you're going to have an income hit, it's going to be smaller. Now, if you've got after-tax money in a traditional IRA, that also would come out tax-free. So anyways, those are some things to think about. So let's go to the next slide. Again, as I said, this is kind of like the wild, wild west, and there's not a lot of authorities. This is your main authority. Let me just sort of expound upon it. It should say IRC section 4975C1. It's not Internal Revenue Code section. It obviously is administered by the IRS. But so the following actions, activities between a plan, and a plan includes a tax-qualified plan or an IRA, and a disqualified person are considered prohibited, whether they are direct or indirect, okay? So it's important to note that direct or indirect, because some cases will pick up on that word indirect because there's not a direct prohibited transaction, but they'll find an indirect one. So, what are they? Sale or exchange or leasing of any property between a plan and a disqualified person. So if you have an IRA and you have some Coke stock on it, you couldn't have the IRA sell the Coke stock to you. Likewise, you couldn't sell Coke stock to your IRA, and that applies to whether the stock is publicly traded or privately traded. Lending of money, you can't lend money to your IRA can't lend money to you. Now, there's a case we'll talk about in a little while which sort of extends this to a personal guarantee of a loan, which, I think is actually a questionable decision, but I'll point it out when we get to it. Furnishing of goods, services, or facilities. And, note, so in other words, you can't go out with your IRA and say, okay, IRA, let's say your IRA is invested in real estate that you are renting out to somebody. And you can't furnish goods or services to the IRA. So you couldn't go out and say, okay, I'm going to charge my IRA $40 and I'm going to cut the grass for my IRA. Okay. Now, but that's a problem that people will get into. They'll buy a real property and they'll want to fix it up. And you can hire somebody to fix it up. But when you start doing things yourself, you're either going to have a prohibited transaction, or at a minimum, you're going to have a contribution to the IRA that you couldn't make, because you're only supposed to make cash contributions to IRAs. That's all the code anticipates. So, if you basically cut the grass for the property, it's as if you put $40 in and then the property paid some third party $40 to cut the grass. So in other words, you indirectly increase the value of the IRA by doing that. So, that's a no-no. Transfer to or use for the benefit of a disqualified person and dealing with the income or the assets of the plan. And that's such a generic, that language is so generic that it's subject to all sorts of interpretations. And there's a regulation, one of the few regulations that have been issued, that sort of, I'll just sort of cover that quickly now, sort of expounds on this this concept. What does that mean? Transfer to or use for the benefit of a disqualified person in dealing with the income or assets of the plan. So you're doing something with generally the assets of the plan that provides you with a benefit. Here's what a regulation says. This is Treasury Regulation 54.4975-6A5 on the line. And it says the prohibitions of C1, E, and F, which we just read, well, that was actually D. Actually, this regulation relates to the next two things: disqualified person dealing with the income or assets of the plan on his own account. So when are you dealing, when is an example of that? A disqualified person dealing with the income and assets of the plan for his own account. Let me give you an example where that would be the case. You own stock, or you own an interest in an LLC, and the LLC is having financial troubles. You take IRA money and invest it in the LLC. There, you took income or assets of the plan and you dealt with them in your own interest, okay? You try to protect this LLC in which you own an interest by using income or assets of the plan, the IRA. That would be a prohibited transaction under the fifth bullet there. And then the last one is receipt of any consideration by a disqualified person from any party dealing with the plan in connection with plan assets or income. And that's generally going to be a kickback. So a transaction occurs, you're a fiduciary, you basically get something for the plan undertaking a transaction with a third party. All right. But let me just read what the regulations say to sort of add to these. There's not a lot more than this in terms of regulatory authority. This is the regulation site I just gave you. It said, these prohibitions are imposed upon fiduciaries to deter them from exercising the authority, control, or responsibility which makes such persons fiduciaries when they have interests which may conflict with the interests of the plan for which they act. In such cases, the fiduciaries have interests in transactions which may affect the exercise of their best judgment as fiduciaries. Thus, a fiduciary may not use the authority, control, or responsibility which makes such person a fiduciary to cause a plan to pay an additional fee to such fiduciary or to a person in which such fiduciary has an interest which may affect the exercise of such fiduciary's best judgment as a fiduciary to provide a service. Nor may a fiduciary use such authority, control, or responsibility to cause a plan to enter into a transaction involving plan assets whereby such fiduciary or a person in which such fiduciary has an interest which may affect the exercise of such fiduciary's best judgment as a fiduciary will receive compensation from a third party in connection with such transaction. And then they talk about services without compensation. If fiduciary provides services to a plan without the receipt of compensation, the provision of such service does not, in and of itself, constitute an act described in C1E or F. Okay, and that's where it gets confusing. Okay, because they're saying if a fiduciary, I cut the grass for my IRA, provides services to a plan without receipt of compensation. The provision of such service does not, in and of itself, constitute an act described in Section 49C1E or F. Now, again, the third bullet there was not E or F; it was C. Okay, so again, I don't think you can. But the language there can be kind of confusing. I don't think you can cut the grass. I don't think you can go out and paint the house, assuming the house is owned by your IRA or owned by an LLC that's wholly owned by your IRA, because a wholly owned LLC owned by anybody is a disregarded entity for tax purposes, so it's deemed as though it does not exist. And so, again, you can't form a single-member LLC and avoid these rules. So, next slide.
Alan, before we jump, I just want to add, we had a couple of questions come in, and we certainly may be something we address as we go on. If so, just let me know, and we'll get back to it. But kind of getting at, someone said, are you allowed to manage your own rental properties? And I think that the problem with their question and maybe giving a more definitive answer might be the word manage and what they exactly mean by that. But do you have any kind of share, I know, your thoughts on that? I don't know we're not going to go through the seminar today and parse everybody's can I do this, can I do that, particular things, but maybe if you had kind of just a general feel on management per se.
Well, let me just say this. There are a lot of different opinions on that. You go from one extreme, if you hire somebody to do everything and just sign a contract with them saying that they're going to find tenants, they're going to make sure the tenants pay, they're going to get paid a commission, that's probably the lowest risk thing you can do. On the other hand, if you go out and you find the tenants, you collect the rent, you do the accounting, you take collections actions against them. Let me just say that none of that is absolutely a problem. I mean, I basically lay out the options available to people and tell them there are varying degrees of risk because there are hardly any authorities in this area. Now, there are some authorities, for instance, 4975 D2 of the code says that, you can provide, accounting and legal and rent space to a plan. That's not a prohibited transaction. And Section 4975D10 says that you can charge for services relating to operation of the plan. Well, ordinarily an IRA owner is not going to have services related to operation of a plan. That's going to be performed by Advanta in this case. Okay, so accounting services by a disqualified person necessary for establishment or operation of the plan, you can make a strong argument that, if I'm collecting the rent and recording it and that's accounting work that I'm doing for operation of the plan. So you can make a strong argument that's okay. Picking out tenants, well, there's a case we'll go over, Cherwenka, in a little bit, where he picked out properties. He decided when they would be sold. That's different than picking out tenants. But I think just picking out a tenant probably is all right. Where the line gets crossed is a fine line that no one knows for sure.
Okay, Alan, I went to the next slide. Just the other question we had, and again, if anyone has any other questions, please get them typed in as we go. I think we'll address this later, but the question was, if your IRA owns an LLC, and I'm assuming a checkbook LLC, can you fund the LLC more than one time and getting into additional capital contributions? I think maybe we'll leave that question if when you start talking about Swanson and some of the other cases. So, but I might up the next.
In case I forget, let me just cover that now because I might forget. If it's an LLC, you're probably okay because an LLC is a disregarded entity. It's like it doesn't exist for all tax purposes. If it's a corporation, it should be a problem because a corporation is a separate legal entity. Now, not in Swanson, there's another case we're going to go over where they didn't even discuss the issue, but it was an LLC. So I don't know whether they didn't recognize the issue, but go ahead. Let's go ahead from here.
Okay, well, here's the next slide for the fiduciary.
Okay, who's the fiduciary? The main thing to notice there for an IRA is that anyone who exercises any authority or control regarding management of the IRA or its assets. That's going to be the IRA owner. Just another thing I'd like to point out here is under B, the person who renders an investment advice for a fee or compensation is a fiduciary. There are regulations that are proposed right now that the Department of Labor is trying to issue to greatly expand the definition of a fiduciary, and they're doing it through this investment advice language. And basically, it's a tremendous expansion. Again, it's under a regulation. I sent in a comment letter myself because one of the things they have listed is if you give advice regarding whether someone should take a distribution from a plan or an IRA, I mean, no other advice. They're saying that's investment advice. Well, I don't think so, and they know it's not. But so anyways, we'll see if they retract on that because I advise people occasionally whether they should take a distribution or not. I don't get into investments at all. So that's just my thought there. But yeah, the IRA owner is going to be a fiduciary with respect to his or her IRA. Next slide. The plan asset rules. These are often overlooked, often confused. Sometimes you'll see a case that comes out, they won't even consider them, and then you're left to wonder, were they not aware of them? Did they don't even discuss them when they could potentially apply? What the plan asset rules say, basically, if plans, including IRAs, own more than 25% of an entity, then generally whatever the entity owns is deemed owned by the IRA, and whatever, as well as the equity interest in the venture. So, in other words, if three IRAs come together and form a business, let's say it's a corporation. The corporation goes out and buys mutual fund stocks. Well, because those IRAs own more than 25%, whatever is owned by that corporation is deemed owned by the IRAs proportionately. Okay. So what that means is if that corporation went out and bought some Coca-Cola stock and sold the Coca-Cola stock to one of the owners, that's going to be deemed a sale by the IRAs. It's not going to, you're going to look through the entity. There are some important exceptions to these rules. First of all, again, a single member LLC, we want to call it checkbook controlled LLC is deemed just like it doesn't exist. So those assets are deemed owned by the IRA custodian for the benefit of the owner. So there are important exceptions to these rules, and they're mainly for operating companies. If it's a real business, it's not subject to these rules. If it's a real estate operating company, leasing real estate, et cetera, it's not going to be subject to these rules. Venture capital operating companies are not subject to these rules. But anyways, let's go to the next slide. UBTI and UDFI. I always just call it UBTI, but Scott has a new term which sounds pretty cool, and that I apparently am not up to speed. But Sections 511 to 513 of the Internal Revenue Code cover UBTI, and they basically say if you're a tax-exempt entity, including a qualified plan, an IRA, or a charity, if you get into a commercial business, you're going to have to pay tax on the profits of that business, as long as it's got to be regularly carried out. So in other words, your IRA can't go out and buy the assets of a McDonald's franchise and then compete with the McDonald's and the Arby's across the street and then not have to pay income tax while they're paying tax. So the whole point is to put everybody on equal footing. So, but UBTI does not apply to passively held investments, such as real estate owned outright. Okay, in other words, there's no debt on the real estate. That it's not subject to the UBTI rules, and other passive income not subject to the UBTI rules are things like interest, dividends, royalties. But rents from personal property leasing, unlike real property leasing, is generally subject to UBTI. Okay, so unless the personal property leasing is basically incident to real property leasing. Now, UDFI is unrelated debt finance income, which basically says if you're doing something that's okay, but you're borrowing to do it, then you're going to have UBTI to the extent that you borrowed to do it. So in other words, if you've got real estate and but you've fully financed it, you borrowed $1 million, your IRA did, and bought $1 million property, all the income from that property is going to be subject to income tax. And the reasoning for this is very complex. It goes back to a 1960 case, and Congress basically took a sledgehammer rather than deal with the specific facts and just said any debt financed income is going to be subject to income tax. But it's only the percentage of the property that's debt financed. So let's say a $2 million piece of property was bought, and $1 million of it was bought with borrowing, $1 million was bought with cash. Well, 50% of the net income, of the taxable income, would be subject to income tax. And basically, you file Form 990T to report the taxable income, and you pay the tax. So again, the taxes here these are not prohibited transactions. You can do this. It's just you have to pay income tax on the income. So, but it's important to note that it's only the net income that's subject to tax. So you get deductions for mortgage interest. You get deductions for depreciation, which can be huge, and anything else related to the business that's an ordinary necessary business expense can be deducted. So it's only the net income that's potentially subject to income tax. So next slide.
All right, again, I had another question come in. I don't know if we can maybe address this one now, or again, maybe we can revisit it. But question came up. Someone says they have an existing Roth IRA that's self-directed, but they are now creating a SEP IRA for themselves. So the two accounts that can't be combined into one, but can this individual use both the Roth IRA and the SEP IRA to partner up on a particular purchase or a particular investment? So maybe not transacting with each other in the sense of buying and sell, the Roth selling to the SEP or vice versa, but the Roth and the SEP both investing into the same asset. What are your thoughts on that kind of partnering arrangement?
It's probably okay.
Okay, as long as they keep the percentages according to the of ownership static.
Yeah, if that's okay. The only fact. If in other words, you're going to take part of the IRA and part of the SEP IRA, invest in a property, off the top of my head, without researching it, it's probably okay. I had a client that had a similar transaction like 6 months ago that I dealt with. But my gut is that's okay. But that's my gut. Again, I always have to research all this stuff. So.
Okay.
Okay, next slide. Swanson versus Commissioner. This was sort of the first big case in the area of prohibited transactions. And again, there's not a lot of cases to begin with. But what happened was Swanson, this guy, basically had a corporation, had some foreign sales. So there was a thing called a DISC, a Domestic International Sales Corporation. It was replaced with a FISC, a Foreign Sales Corporation. Basically, they did the same thing. You would basically have your corporation pay commissions to the DISC, and the DISC's income would either be exempt or largely exempt, and then the company would get a deduction for the commission it paid to the DISC or the FISC. Well, what this guy did was he set up this DISC in his IRA, and so all the DISC income was going to be tax exempt, and the corporation, I think it was an S corporation, but I don't remember, was going to get a deduction. So basically, he was going to take some of the income from his regular business and make it tax-free. And the IRS went after it and said, this is a prohibited transaction. You're going to own 100% of this business. Well, the court said, well, hey, before this transaction, there's a nothing. There is no corporation. So there can't be a disqualified person when there's a nothing to begin with. So once he formed the corporation, then the DISC was a disqualified person, and if there was a transaction between it was a transaction between the plan and someone else, there could potentially thereafter be a prohibited transaction. But just the formation itself couldn't be a prohibited transaction because you didn't have a disqualified person to begin with. In other words, the plan invested in an entity that was created, and the entity became a disqualified person after the transaction, but because it didn't exist beforehand, you couldn't have a prohibited transaction. So this is a very controversial case. Some people think that the case doesn't stand for what I just said. Some people think that there's no problem with this transaction, even without this rationale. Other people think it's just wrongly decided. But I think it's pretty safe to assume that this is an okay thing. And if you've got a single member LLC, this was a corporation, which is a separate legal entity. A single member LLC, for all tax purposes, is a disregarded entity. So if you form a single member LLC, and put money in it, or other assets, it's as if you did nothing. So that's all I want to say. Other than, let me just say this: these cases, the cases are kind of all over the board. And if you get into litigation in tax court, or typically you're going to be in tax court, anything's possible because there's not a lot of authorities here. And you just don't know what is going to be cited, and you don't know how it's going to come out. It sounds kind of crazy, but so let's go to the next slide.
And Alan, as we go through too, if you could just maybe offer a brief comment. The first couple of things we're talking about here are court cases. Then we get into advisory opinions. Maybe just give the listeners and the viewers a kind of what the authority is for a tax court case versus an advisory opinion or a private letter ruling kind of thing. Just maybe quickly cover those so they kind of know, is it stuff they can rely on, or are some of these things central to only one individual?
Yeah, I mean, a case you can rely on, and the higher ranking the cases, the more you can rely on it. A Supreme Court case is the most reliable source of authority in the area of taxes. Tax court case, if it's not appealed, is generally authority you can rely on. And you get into things like DOL advisory opinions, which are just basically nothing. They're just opinions of the DOL. And the Department of Labor, just so you know, changes its opinion regularly. I've seen it happen many times, including this example I just talked about, where they're going to make advice regarding taking a distribution from a plan and IRA investment advice. 10 years ago, they did an exact 180. They said just the opposite. That is not investment advice. So now there are a number of areas where they've done 180s, and they're not law. if you were to rely on it, it'd probably help you if you ever got in trouble to get you out of penalties and whatnot. But anyways, so okay, the next case. Let me read the rationale from the tax court in the Swanson case. They said a corporation without shares or shareholders does not fit within the definition of a disqualified person. It was only after Worldwide issued its stock to IRA number 1 that the petitioner held a beneficial interest in Worldwide stock, thereby causing Worldwide to become a disqualified person under IRC section 4975. So that's the direct wording from the court. Now we're on Rollins. Rollins, this was not an IRA, it was a tax-qualified plan. This actually happened in Atlanta. Rollins was in Atlanta. He had a business. He had a regular business that had employees, and he had I think it was a 401k profit-sharing plan. It might have just been a profit-sharing plan, doesn't matter. But he took the assets of the plan that his employees were invested in and invested them in, bought minority interest in some businesses that he already owned interest in. So the court had no problem finding that this was a prohibited transaction. He acted for his own benefit to the potential detriment of his employees. And I think this is the right conclusion. No doubt, don't do something like this. But you're not going to have something like this in your IRA. So the next case, Ellis versus Commissioner. This was a tax court memorandum opinion. It was just affirmed by the 8th Circuit on June 5th of this year. A guy owned 98%, got a lot of legal advice, professional attorney, CPA, whatnot. Put 98% of his asset, took cash and got back 98% of the interest in an LLC. An outside party owned the other 2%. He made 2 separate cash infusions, which the court didn't say anything about. But I personally think that alone under Swanson should have been a prohibited transaction, because once he owned 98% of the LLC, it should have become note he didn't own 100%, he owned 98%. So that should have become a disqualified person. And the second cash infusion should have been a transaction between a plan and a party in interest, or a disqualified person. But the court just glossed over it, didn't think anything of it. I don't know if it was because it was only 2 months apart that the second infusion was made, or they just, again, a lot of these things, you don't know whether they just didn't recognize it or what they were thinking. So didn't have a problem with it, but ultimately the guy received, this was like a car dealership or a used car dealership, and he received his salary, a very small amount, as compensation from the LLC, and the court said that's a prohibited transaction. He tried to argue the plan asset rules and whatnot, and they said, look, this is a direct or indirect receipt of benefits, from the IRA. Now, he was trying to say that plan asset rules suggest that this is treated as a separate entity because it's an operating company. So if it's a separate entity, even though it's a disqualified person, I'm getting a salary from it. I'm not getting a salary from the IRA. I'm getting it from this separate legal entity. But the court said, no, that money actually came from the IRA and went in there. So the problem was this happened very shortly after the entity was formed. It was either the same year or the next year. But let me tell you this. I had an example of a situation where we set up an entity a few years ago where a guy owned 49%, another guy owned 49%, another entity owned 2%. So it wasn't a disqualified person. Well, this guy paid out every dime he put into the entity to a third party to create a software program for this business. This was a separate business. It wasn't real estate. But this guy basically lost his job making $400,000 to $500,000 a year, and he wanted to form this healthcare company that he had thought about for a while, and it was basically to help people with high deductible health plans and HSAs to find the best mix of providers from step A to step Z of a procedure. And so that's what his business model was. Well, all the money he put in went out the window. So, later on we got into issues of he wanted to put some more money into the LLC, and the question was it going to be a prohibited transaction? And then could he later draw a salary? Well, under this rationale, he's okay because the money from his IRA was gone, and it went to a third party to pay for a business asset. So if the business eventually made money, he could basically, under this rationale, take money out as compensation because the LLC was not a disqualified person, and he wasn't taking assets from the IRA. I hope everyone understands that. Now, let me just tell you, there's two statutory exemptions. One of them I mentioned earlier. There's an exemption where a disqualified person can be paid from an IRA for rental of space to the IRA or accounting or legal services provided for the IRA. And there's a separate exemption for plan operational services, which you shouldn't have in an IRA. So anyways, let's go to the next slide. Peak versus Commissioner. This is a tax court case. These two guys basically did this in 2001. They each took their IRAs, did the exact same thing. They took their IRAs, their IRA money, they took and they formed a new business. Then the business went out, and it bought the assets of another business, okay? And they basically paid for it partially with the assets they had from their IRAs they put in this company, and partially with a promissory note. Well, the seller made them personally guarantee the note. So these two guys guaranteed the note. Well, so that's in 2001. And the company becomes profitable. 2003, 2004, they make Roth elections thinking, hey, this is going to be something big. Let's recognize income now, and then when the thing gets really big, we'll get the rest, we'll get the rest tax-free. We'll get it tax-free. So 2003, 2004, they make Roth elections. 2006, they sell the company for a big profit. IRS audits, says you committed a prohibited transaction when you personally guaranteed those loans, and the IRS won in court. Now, I personally think this case could have gone the other way because the court said that they directly, or that says it was an indirect loan. And I personally don't buy that. A guarantee is different than a loan. Now, you could say that they still, did something to benefit their IRA, but there's some case law that says, in the tax qualified plan area where a sponsor can receive sort of an incidental benefit from a transaction, and that's not a prohibited transaction. I think this case could have gone the other way, but it's out there. It's very dangerous to guarantee a loan relating to your IRA. But again, the court just said, hey, this is an indirect loan. I personally don't buy that, but, I'm not the court. So anyways, Cherwenka, the next thing, this is kind of interesting because we have about 12 minutes left. I got a call in September 2000. Actually, the guy down the hall from me asked me on a Friday afternoon, can you be an expert witness in a bankruptcy case on Monday? I'm like, what? So next thing you know, Monday morning, I show up to be an expert witness. The judge, who was my former partner at a law firm, had just received notice of this proposal that morning. She said, no, he can't be an expert witness because I didn't even receive this request until just now. He can be co-counsel if you want for this hearing. So I ended up being co-counsel for the hearing, which was pretty bizarre. And I ended up giving the closing argument, which was basically turned into a conversation between the judge and I. And the judge is very smart, very likable woman, done bankruptcy for years and years. And I don't think she favored my client because I was previously her partner. But the facts of this case, you can find it on the internet. If you just put in Cherwenka, you'll find the case. Put in Cherwenka in bankruptcy court, and you can pull up the opinion. But this guy, he skated around these prohibited transaction rules better than anybody I've ever seen. And there were and he basically, this wasn't the IRS going after him. These were the creditors who really wanted this guy badly, I can tell you. And they were trying to basically say a prohibited transaction had been committed, therefore his IRA assets were deemed distributed, and he owns them personally, so he can get access to them. Whereas if they were in an IRA, they're tax exempt of the bankruptcy laws. Well, what's interesting about that is, the prohibited transaction rules are tax rules, and they say the assets are deemed distributed. Query whether that means they're deemed distributed for non-tax purposes. Well, I don't know of any authority that's ever considered that, but this case sort of assumed that was the case. If you read the opinion, but I don't know whether a tax authority has the authority to say, something that's deemed to happen for tax purposes happens in reality for non-tax purposes. But if you read the opinion, Mr. Mike Cherwenka, skates in and out, and he basically decides it was a house flipper, and he ran out of money personally. Started doing it through his IRA. Some of the houses got fixed up, some of them didn't. He was involved heavily. Decided what was going to get bought, what was going to get sold, what was the price was going to be. And he actually had a 55-45 deal between where his IRA partially owned the property and he partially owned it. And I argued to the judge that was acceptable because there's a DOL advisory opinion where that was deemed permissible. And Madoff, I can't remember his first name, but it was investing in his partnership. A family had invested in the Madoff partnership, and one of the family members invested IRA money, and another family member invested personal money, or it might have been the same individual who did both, and that was the Department of Labor didn't raise a problem. This judge said she would have had a problem with it, but my recollection is she said that it wasn't proven, something wasn't proven there, but I told her I thought that was okay. But anyways, it was ruled that he had not committed a prohibited transaction. He was okay. So next slide. This is an advisory opinion. This is not law, so I don't want to spend too much time on it. But you just know here that there's an S corporation where Robert was the controller of the S corporation, and an LLC was formed where Robert's IRA owned 31%, and the property was leased to the S corporation. And the DOL said that'd be a prohibited transaction. I'm not sure whether that's correct or not, but let me just say this. If you ever want to go to the government to get a ruling, whether it's the IRS or the Department of Labor, I would think twice about it because they are never going to give you a clean ruling. Even if you ask them, hey, is this okay under, C, A, B, C, and D, they're going to say, oh, yeah, but we're not going to say anything about E or F. And E or F are the two where it's very gray, and it's like, anything can happen. So you're just sort of waking them up to something they probably weren't going to look at to begin with. So I basically counsel people don't think about that route unless you're some major company and you're. Okay, the next slide is opinion 89-03. Again, not law. This was an executive. The company was actually Rock 10, and the executive was high ranking, and he owned more than 1%. When he looked at all of his ownership interests, he took some IRA money and bought company stock. Said it wasn't a problem. The company wouldn't have been a disqualified person. So that was okay. Zablotny is sort of a bizarre case where the court basically said, yeah, there's a prohibited transaction, but the investment turned out great. So all we're going to hit you with is the 5% excise tax, which people just sort of scratch their heads at this one. Because the transaction was not undone, and if it's not undone, you're supposed to hit them with 100% excise tax. Back then, it was a 5% excise tax. Now it's 15%. But basically, the court said, yeah, under these circumstances, blah blah blah. And we like the old guy, and he made a pretty darn good investment. And so, if you try to square this with the rest of the stuff, I don't think you can do it. But it's out there. Next slide. Real estate, how much can I do when it comes to repairs, choosing properties? I would suggest you read the Cherwenka case if you're thinking about that. Again, another judge could rule differently than the Cherwenka judge, but she, in my opinion, she's a very smart person, judge, and I think she did a really good job with it, other than I disagreed with her on the 55-45. Can I choose my rehabbers? Mike Cherwenka did them. And can I use rehabbers from the IRA property that I use on my personal property? I don't see any problem with that. Can real estate agents earn a commission? I don't know off the top of my head. That sounds like a problem. Loans, do equity participants? Anyways, do we want to go through these, or do you want to open up the questions?
Actually, I had another question come in. If anybody has more, get them typed in here as we're wrapping up. But the question came in, says, is there any problem for an individual using their self-directed IRA to buy raw land, use the cash within the IRA to build a home, and then sell the finished product? They would be hiring contractors and paying out to everybody else to build the property. So the IRA is, just the cash in the IRA to acquire the land, build the house, and then sell it. Do you see any issues, potential problems there that they'd want to be aware of?
No, as long as you hire, in other words, hire a sales agent to sell the house, or you're going to use an agent, you can be involved in deciding who it gets sold to, what the price is. You can pick the piece of land. You can specify the house that you want, but you can't go in there and build it in any fashion. Anyways, I think that answers the question. And
okay.
Reach your Wenka, that'll help you.
Okay. The one question I had, and this is something we do get asked from time to time, I've heard people mention it, when there's kind of this question under the loans. If I was lending money on a mortgage loan, just getting back a flat interest rate, I don't think there's any issue with the UBTI. But if I was lending money to somebody who was, say, rehabbing a house, and then they are splitting profits with me as opposed to just paying interest, just any thoughts you had on if that falls subject to UBTI now that I'm kind of, am I engaging in business activity by sharing in profits on the sale of a rehabbed house? And if there's something kind of outside needs more research, that's fine too.
Give me those facts again.
I have money in my IRA, and I lend it to someone who's going to rehab a house. And in exchange,
I had a guy in my office this morning that's what he does. Go ahead.
Yeah, and so if so when they pay me back to satisfy my mortgage, rather than pay me 8% or 10% interest, they are going to give me a quarter, a third of the profits they make on the rehab. So that the payoff of the mortgage is basically giving me profits from the sale of the house as opposed to an interest rate. Do you think that will rise at all to the level of UBTI?
I don't think so, because it's got to be a business regularly carried on. I mean, again, McDonald's is selling French fries every few minutes. If you're occasionally going to get a piece of the action on a deal, that's not going to be a regularly carried on business that's going to be subject to UBTI. So, the guy I had in here this morning, he loans hard money, and then he sometimes does it through, like, we formed an LLC. We've done a few of these. A lot of people are looking to get out of the market, and they want to get into these hard money loans because they have higher interest rates. There are significant points, and you have a security interest in the house. And typically, the lender will say, "Yeah, I'll give you this, 12% loan or whatever, as long as it's not a usurious rate." And the returns are great. They're just that. Because a lot of banks won't loan to them. So a lot of people are doing that, and as long as it's interest, it's going to be, tax-exempt income. And it doesn't matter whether you do it through individually or with others through typically people form an LLC, and you can get a piece of the action on a sale of property as a share, so sort of like a partner in a partnership. Again, because that should not be unrelated business income that's regularly carried on by the LLC or the IRA. So.
Just want to hit a couple questions on this last slide really quickly. I think we addressed the additional capital contributions. If the LLC is owned 100% by the IRA, I think you said that additional capital contributions later are probably not a problem because the LLC basically doesn't exist for tax purposes. But I guess if there were going to be a partnering situation with the IRA and other people in the LLC, then you would have to definitely be careful or maybe not make the capital contributions at all.
Right. It's a different tax pattern. If the IRA invests in a partnership, that's different than a single member LLC. And if the partnership is a disqualified person, a subsequent contribution should be a prohibited transaction. Because it's a sale. Go ahead.
No, that's fine. Go ahead. Finish that. I had another question.
Go ahead. Go ahead.
Okay. Well, just the formation, a question we get from time to time, if we're setting up an LLC for the IRA, should the IRA pay for the formation, or is it something the IRA owner could pay personally? What's kind of your best practices on that?
Well, again, if it should be an expense of of the IRA. So the IRA should pay for the formation of the LLC. So what I typically do, which again, none of this stuff is 100% clean, but people will come into me and say, hey, I want to do that. And so I get paid because I have to form the thing, and I have them, so I sign a contract saying, I'll form it, you'll pay me. But when the entity gets funded, the entity will pay me, and then I'll reimburse you personally. So the end of the equation is the IRA paid for it. And the reason you need to do that is otherwise you either have an indirect contribution of whatever the cost was to form the entity, which again is you're supposed to just put cash in, and here you've sort of performed a service, and could it be a prohibited transaction? Possibly. So again, really the clean way to do it is just have the IRA pay to have the LLC formed.
Okay. Well, again, Alan, I thank you very much for your time today. It's been very informative. I'm sure the people listening, either live and also ones who are going to watch the recording, have got a lot out of it. If anyone has any follow-up questions for either myself or Alan, my contact information is on this last slide. If you'd like to look into having Alan help you out with your questions on IRA, you can reach him. His number is 770-319-0110, and his email is ab, as in boy, at alanbuckleylaw.com. And we're going to send a recording out to everyone who is participating live. You can just bump back through the slides as well and get his contact information there as well. But again, thank you, Alan, very much for joining us today.
Okay, Scott, take care.
All right, thank you. Thank everybody again for listening. Bye-bye.
Bye-bye.